Well, good morning and welcome to our Firetrail Webinar on what are the best investment opportunities looking beyond the current turbulent investment environment. I think there's a lot of commentary out there at the moment looking at the immediate impacts resulting from the current COVID environment. But what we're going to do today is look into the post-COVID world and discuss the once-in-a-generation investment opportunities that the Firetrail High Conviction Australian Equity team are seeing in the market at the moment. My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle are equity partners and work alongside the Firetrail business to distribute their high conviction and absolute return funds to the Australian financial advisory marketplace. Just in terms of background, Firetrail was established at the start of 2018, whereby the whole investment team joined the Pinnacle Investment Group and set up their own funds management boutique after having a long and esteemed history of working together at Macquarie. Just on that point, it's important to note that the Firetrail business is exactly the same investment team, same investment philosophy, same investment process, and even the same risk management. So turning to today's presentation, we're delighted to be joined by Blake Henricks, who's the Deputy Managing Director and Portfolio Manager. Today's Firetrail presentation will last around 15 minutes, and we have been sent a number of questions in by attendees, so we'll cover off those in our Q&A session. So without further ado, I'm delighted to hand you over to Blake Henricks to run you through today's presentation. Thanks, Blake.
All right, great. Thanks, Mark, and good morning, everyone. Thanks for making the time. Cormac, can you just go forward a few slides, mate?
Yep, all done, buddy.
Perfect. Thank you. All right, so I wanted to talk about three things today. The first one was, I guess, how you should really think about navigating the current environment. The second one is portfolio positioning. Where is the high conviction fund positioned? With also a deep dive on Qantas, where we're getting a lot of questions. And finally, the opportunity for active investors, covering some of the big opportunities out there right now. So I think the overarching point here today is that yes, risks are elevated, but so are opportunities. You need to be active in this current environment. So if we just duck to the next slide, when you're investing right now, there really are four key questions to ask. And the first one we're asking for every one of the companies where we invest in and we're looking at is, what is the sensitivity to coronavirus and the COVID-19? That question is not easy because it's evolving so quickly. And we all know that, it's gone from not much to a lot, and now it looks like we might be coming out of it in some way. But what you need to understand the sensitivity, both of the operating earnings, but also of the balance sheet. How long can the company survive in a lockdown scenario? I think we know what these lockdown scenarios now look like. For airlines, they're the worst. For others, like a supermarket, it's much better. But how long can it survive? Thirdly, are there any structural impacts that we should be thinking about which are going to affect the long-term rating or the long-term operating earnings potential? This could be things such as demand, and so we're going through a lot as a team of what are going to be some of the structural impacts of demand and what are going to be more cyclical. Secondly, is there going to be any changes to industry structure? I think the answer to that for many of the industries that have been so affected by the COVID-19 is there are going to be changes to industry structure, particularly in some of the travel areas. And then fourthly, and this is something really, really important, is what's priced in. Because many people have talked about how bad it is. I think it is very bad. We've all had friends, families, we've all been personally affected by this. But there's always the question, what is in the price? And so stocks have moved in the past, let's even say last month. Some stocks have doubled off where they were on the low point because too much was priced in. So, that's a key question, and that's, as active investors, what we're thinking about a lot as well. So there's sort of four big questions that we're really thinking about for each of the companies we own. Next. In terms of the portfolio positioning, I've really split the portfolio into four key areas. The first are cyclical leaders, and so cyclical stocks have been heavily impacted by coronavirus. But in these cases, Qantas, Worley and Seek, yes, all going to be impacted, but much higher margins than all their competitors and are well placed to actually take market share through what is going to be a tough period. Importantly as well, we believe the balance sheets are strong enough to withstand very tough scenarios. Secondly, the defensive leaders. So these are companies that we think are really good value and are probably less impacted by COVID-19. Amcor, the packaging company, and that's an interesting case study where there's been a lot of concerns around packaging and potential to move away from plastics into others. Our view was we wouldn't see a really sharp move away from plastics. We may see it at the margin, but instead, to solve the plastic problem, we actually needed to increase recycling. But what we've actually seen now, many of our channel checks are indicating that demand for plastics is back and actually coming back quite strongly, particularly bottled water and other areas. Now, it's not a big earner for Amcor, but at the margin, many of those headwinds that Amcor were facing, look to at least temporarily have been put to the side. Then we go to low-cost commodity producers. We really have focused the portfolio and have been positioned here in all these stocks for the last little while. But tier one producers who can make money, or at least break even at very low prices. So Newcrest in gold, although they're not anywhere near the cost curve. All gold producers are making money at current prices. But Oz Minerals, who is the largest copper play, pure play copper play in the market, and also Rio Tinto. And then finally, just stocks that we think have just been, really unloved, deeply undervalued. So Treasury Wines, which we entered into a position in February this year through Jan and Feb. Virgin Money, which we've owned for a while, and also New Farm. So, the current market conditions have created exceptional opportunities. I think if we had to summarise what we've been doing, we've certainly been increasing positions where we think there's better value now than there was before, particularly Qantas. And we've reduced the positions in companies who've held up better, or just we think there's better opportunities. So that's trimming positions in companies like CSL, Orica and Transurban. All right, Cormac, we'll go to the next one. So one question we're getting a lot is Qantas, and Qantas today is our largest position in the portfolio because we have been increasing our position. Prices much lower than today. But the reason we own Qantas, like Qantas, and really have conviction in Qantas is because Virgin Australia was loss-making prior to the coronavirus. To put it in context, and I can't be any more clear about this, Virgin has not been a well-run business. Since 2006, so that's the past 13 years, the business has lost $1.8 billion of cash. So that's taking all the operating cash flow and taking out all the investing cash flow. So over 13 years, they've lost $1.8 billion. This is pre-COVID-19. At the same time, Qantas over the same period has generated $5.8 billion of cash flow. So it's a pretty significant differential. And one of the changes we have seen over the past year prior to COVID was that new management had come into Virgin and were much more focused on profits rather than trying to take market share against Qantas. Now, obviously, COVID has really changed the game. And yesterday, Virgin officially went into administration, the voluntary administration. I think at the moment you'd have to expect potentially someone to come back. But the challenge we see is that if we put ourselves in the position of a potential owner of Virgin, what would you do? Because there's some significant structural advantages that Qantas has in the market. And so if you can see on the two charts on the left, first half 20 earnings, so this is to December 19, you can see Qantas was making a 14.4% EBIT margin, whereas Virgin, Virgin, the brand, was making a 5.3% margin. And that really came down to, and why is there a difference in profitability? Because they're both selling seats on an airline, is that Qantas brand commands a 20% higher price, thanks to its dominance, particularly in the corporate market. And yet their costs are only 8% higher on an available seat kilometre basis. And that's a structural advantage that Qantas has. On the low cost side, it's actually even more stark. So Jetstar versus Tiger, and as many of you know, Tiger is run by Virgin. Tiger's been break even in December half, whereas Jetstar was making a 16% margin. And so while many of you who've flown Tiger would think, well, gee, this has got to be the cheapest airline. If you actually look at the numbers, Jetstar commands a 7% revenue premium, which probably isn't surprising, but they also run at a 10% lower cost. So anyone who was going to take over Virgin would have a pretty difficult decision to make as to whether they just want to be a low-cost airline or whether you want to go down the premium route. We think it is much more likely to go towards a more domestic, smaller business rather than trying to get bigger and get scale advantages. Underpinning the valuation of Qantas as well is the valuable frequent flyer business. Arguably it's gotten in a stronger position. If any of you've got Velocity frequent flyer points, you probably got an email yesterday saying redemptions have been frozen. And I'm sure if any of you have business trips coming up over the next 6 months or even personal trips, the chances of booking a flight with Virgin would be pretty low, almost at any price. So there's a couple of things to think about there as well. Our base case at the moment is a reduced flying scenario. So that is, domestic does come back. There is high potential, we believe, for quite a big domestic demand return, because as people, instead of going on international holidays, go domestically. So this is what we call our reduced flying scenario, where domestic comes back, but still lower than it was before, but international runs at a very, very low rate. But even under that scenario, because of all the changes we're seeing in the market, we believe Qantas, you're buying it on less than 4 times FY22 earnings. And so, yes, the top line, has been heavily disrupted throughout this. Not being able to fly is a major impact, but the competitive changes that are going on, particularly Qantas versus Virgin, and the potential for the domestic economy to open up and allow flying, Qantas's material competitive advantages really are going to come home. And this is actually, probably the biggest opportunity we see in the market right now. Next one. All right. So in terms of the opportunity for active investors, there's really 2 areas here. The first one is capital raisings. So there's been $9.3 billion of COVID-driven equity raisings so far. This is up to close of business yesterday. This morning we've seen Ramsay Healthcare, which we don't own, has come out. I think they're raising $1.4 billion. So we can take that up to 10.7 now. To put it in context, through the GFC, there was $100 billion, over $100 billion of equity raised. And that was sort of over a period of around a year. So we're only a month and a half into it, and we're probably tracking right on target. Now, it is different. This is a real cash flow crisis, whereas the GFC was much more about balance sheet repair. But I would expect, more of those to continue. Now, the opportunity here for active investors is around taking advantage of some of these capital raisings. Although we have seen some pretty differing performance, and I'd really split it into 2 categories. So the best performers have been the ones where the market was pricing in a raising. So you've seen companies like Kathmandu, iMedia, Webjet, Flight Centre, all who'd been heavily beaten up, all rally around 40% from the issue price. The worst performers in the capital raising area have been unexpected. And that I put in those categories Metcash and QBE. And in both those cases, the stock is now trading below where the issue price was. So you wouldn't have made any money by participating in those. And I think that's one of the surprising things about what we've seen in the capital raisings is, there's some who are pretty obvious, like an Oil Search or a Flight Centre, because they've been so heavily impacted. But a company like QBE, which writes insurance, what's happened there is they put a lot of the premiums they receive into investments, often low risk and credit, but they do also have equities and EM debt. And they took such a haircut on some of those investments that to get back to the top of their regulatory capital minimums, they decided to raise equity. Metcash is another one that's been trading very well in terms of the stock price, because demand for grocery had meant huge benefits there. But they came out with an equity raising, and the reason for it was a large working capital drag, because as grocery sales have spiked, they need to go and buy more stock. They need to rely on their banks to provide them that funding, and the banks effectively ask them to increase their equity. So both of those are now trading below their issue price because they were unexpected. I will say one other thing on the capital raisings, and this is quite different to the GFC, is that the way these raisings are being allocated is very different this time around. In the GFC, if you didn't own shares, you could get access to these placements. This time around, we're seeing them heavily skewed towards existing shareholders only. So if you're not an investor in one of these companies, it's unlikely you'll be able to participate in a placement. So what that means is you need to think a bit differently. Probably for this call, I'd rather not go into exactly how we're doing that, but if you want to take it offline, we're happy to either contact Cormac or Kyle on our sales team, and happy to give you a bit of a sense of the way we're playing it at the moment, because the simple way that was done through the GFC, it's quite different this time. But I think we've been quite successful so far in participating in some of these. The second opportunity for active investors is, looking through the noise and it can give you some reasons for optimism. And this is not to say, to be absolutely clear, that we're super bullish on what's going on in the economy out there, because things are just so tough. And the longer it goes on, the worse the impact's going to be. But there are some reasons for optimism in certain sectors. So the first one is, potential for a demand surge, where, certain products and services that have been impacted by COVID can bounce back. Now, it doesn't mean I don't think international travel is going to be it, but domestic travel, yes. I think increasingly people are going to want to socialise as much as they can, things that they've been holding back on. We could see a bit of a demand surge there. Secondly is market share winners, and market leaders can consolidate and gain further market share. And I think this is a really important point, is that we don't need, for many industries that we're looking at, particularly ones that have been heavily affected, demand to go back to where it was. I'll give you oil as an example. Oil market's 100 million barrels a day. Currently demand's down 30%. Now, it's unprecedented like everything else in this, but that's 30 million barrels a day of demand have been lost. Now, the market can't rebalance that quickly. OPEC plus has tried to take out around 10 million barrels. Others are going to try and take it out, but you can still see the market's heavily oversupplied. We're going to see some long-term or some short-term decisions affect long-term production. And so I think even if oil bounced back to, let's call it 95, which would be down 5%, which would be close to worse than the GFC, once it normalises, you could actually see oil prices higher than they were leading into the crisis. And the reason for that is supply has been impacted. And the same is true for Qantas. You don't need to see travel go back to where it was to see them making the same or more than they used to. And finally, what is in the price? Unloved companies trading at deeply undervalued prices because, potential liquidity issues in terms of people forced selling as they unwind certain positions. This is a real chance to do fundamental analysis and work out where are those best capital deployment opportunities. So I'd say, there's two sort of big areas, the capital raisings and looking through some of what's going on, because there are some pretty serious opportunities for active investors with a long view right now. So guys, I've got 17 minutes. I've targeted 15, so I'm 2 over, so I owe you 2. But, the key points I wanted to make today were that the current environment does require investing discipline, really thinking about the company's impact and also what's in the price. Second, the portfolio is well positioned for the medium term across both, cyclicals, defensives, commodities, and also some of these really deep value opportunities. And finally, there are some exceptional opportunities for active investors, but you're having to play it quite differently to the GFC in our view. Brilliant. I'll hand it over there, Mark. Thank you.
Brilliant, Blake, and great to get Firetrail's views on where you're seeing opportunities. I can certainly tell with the enthusiasm in the Firetrail team that these are certainly some once-in-a-generation opportunities that are presenting themselves in the current market, but obviously assessing the risks as well. Look, before we get into questions, it's important to note that the senior members of the Firetrail team have been managing money for a long time. And on that point, Patrick Hodgins, Firetrail's managing director, portfolio manager, was managing money not just through the GFC, like when Blake was also managing money, but it was also managing money during the dot-com bubble, but right back as far as the 1987 crash. So I think my point is really, whilst these dislocations can be uncomfortable, Blake, Patrick, and the team, they've been here before, and they've got a great ability to cut through the noise, assess the facts, and translate them into solid returning investments, especially when you're looking to invest for the longer term. Okay, so as I mentioned at the start, we're going to kick off with some questions, and a number of people have been very kind enough to submit questions prior in the email promotion that we did. So, Blake, we'll kick off with some of those. Given Australia's success so far in containing the spread of COVID-19, does the Firetrail team have a preference for companies whose performance is tied to the local economy?
Yeah, my view here is in terms of the local economy, because something being talked about a lot, given our infection curves being flatter, but you need to take a balanced approach. So yes, the Australian economy is likely to come out of this faster than other economies because we have got a flatter infection curve. I spoke to the Woodside CFO last night, 0 cases in WA. Queensland I saw yesterday, 0 cases. So, we are coming out of this faster. But I guess the question as an investor is that going to last for 1 month? Are we going to be ahead of the curve for 1 month, 3 months, a year? Because when you are buying a business, you're paying a lot more than the next 3 months of earnings. The average Australian company at the moment, you're probably paying around 17 years of earnings. So yes, that could be a trade for a week, 2 weeks. But if you do believe that Australia can come out of it, then other economies potentially can come out of it as well. So, should we be heavily biased to Australian stocks? I think at the moment the answer is no, because and even if you think about that in practice, you probably would have sold China in January, then you would have bought it when it improved, and then you would have sold the rest of the world, and then you'd be buying Australia, and rest of the world could potentially improve in the next 6 months, and then you'd be buying those companies. So that it's really too short term to be playing those kind of opportunities in our view. At the moment, in the Australian bucket, we are focused in the portfolio. Some of the market leaders I've talked about, like Qantas, Seek, and even Cleanaway.
Okay, mate. There's a couple of questions that have also come in live, so I'll tick to those as well. Why would you hold any stocks that are sensitive to COVID-19?
So I think firstly, I'd say almost every company is impacted by COVID-19. There are a very small handful of companies that are really positively, and it's obviously positively impacted, like a Fisher & Paykel, who does a lot of the ventilators and work in healthcare. But even companies who you would think would benefit from a COVID-19, let's say like a Metcash with a big grocery exposure, are having to raise equity, and it's causing issues in their business. So the first thing is, I think the number of stocks that are not sensitive to COVID-19 is a very, very small list of stocks. Secondly, I think, that there are opportunities in some areas where the market has, I wouldn't say capitalized the current situation, because if you capitalize the current situation, then the economy doesn't really exist. But I guess probably priced in a more severe impact than what is reasonable. So in some cases, it's actually better to take on risk in some of these areas. And Qantas, we've talked about it a lot. Don't want to make it about just one stock, but that is an area where we've been happy to take on more risk. In other areas, we've been more willing to take risk off the table because we think the impacts are perhaps underappreciated.
Okay, another live question. The energy sector feels like it's higher risk at the moment. Why take the risk with a stock like Worley Parsons?
Yeah, so we've been increasing our risk exposure to the energy sector in the last couple of weeks. The reason for that is that the current prices just aren't sustainable. We saw prices go negative yesterday and the day before because we're seeing such oversupply in the market. We estimate around 25% of current producing supply is uneconomic at current prices. And the issue is not OPEC, it's not what they can do, it's the issue is demand. And right now demand is down 30%, and there is no amount of production cuts that are going to make the market balance right at the minute. So what we're seeing is demand, the way we're thinking about this is demand won't get back to where it was anytime soon, but supply has been greatly impacted. And to put it in context, as I mentioned before, the market size is 100 million barrels a day. OPEC has cut 9.7 million, so it's about 10%. The US is likely to fall around 2 by the end of this year, and many other countries are being impacted, like Canada and Brazil. So investment is falling right now. Some fields are going to need to be shut in, and that can cause permanent damage to future production because of the way the reservoirs work without material investment. So if you do see demand come back, and let's call it 90 to 95 million barrels a day, maybe down 5 to 10%, you could actually see the market coming something closer to balance. And so right at the moment, it's all about demand. And we can see prices back up at $50 within the next year because of that supply impact. And the same is true for Worley. Worley is being impacted as people pull back on investment capex. But I think the difference between this oil price route and the one in 2014 was that Worley going into it last time had 85% of their revenue tied to hydrocarbons. This time around, it's something closer to 40%. 20% of that is capex and 20% is opex. Everything's going to be impacted, but they're much less exposed, so half as exposed as they were last time. And the second thing is last time they were taking a long time to send out bills. So in some cases, it would take them 30 days just to send out a bill, and so their working capital became quite stretched. This time around, under the new management, and we've been talking about this for a while, heavily focused on cash collection and ensuring they're well positioned. And so we continue to believe that Worley will be able to trade through this as well as possible. But that's not to say there's going to be no impact, because that is not true.
Okay, mate. Another question that's submitted early in advance. Do you think China will still grow, and can Australian companies benefit like we have post GFC in a post-COVID world? And kind of combining another question is what's your exposure to China?
Yeah, so in terms of China, I mean, I think they can grow. They're heavily domestically focused, but equally, there's a lot of manufacturing that goes on in China, and so no one's immune in the global economy from if the whole rest of the world slows down. China is going to be affected. So the obvious candidate would be something like steel and iron ore would be beneficiaries, because if everything does slow, China's go-to has been infrastructure demand and stimulating the builds of infrastructure and property and supporting it in that way. So far, we haven't actually seen that this time around. China's been much more focused on fiscal stimulus, making sure that small businesses have enough cash, that the banks are well capitalised and rates are low. So we haven't seen it this time around at the moment, but I don't think it's something you can discount. So I think, broadly you can rely on China to continue its growth path, but they will be as impacted as anyone else out of this. But Australia is well positioned given that iron ore exposure I talked about. In terms of our China exposure, I'd say probably the portfolio is broadly neutral iron ore. And then we do have a company like Seek, where you're going to be exposed to a long-term thematic of jobs growth. And yes, the macro is weak at the moment, but we do still believe in the urbanisation story and increasing labour mobility, and also Treasury Wine. So that's another one in that China exposed bucket, where we've got exposure there. So I'd say we're overweight China, but it's sort of hard to split out exactly what in percentage terms.
Great, mate. Now, we've had a couple of questions come in live on the banking sector. Do you see it as low growth? What's your preferred exposure? Anything in relation to the insights into the industry and housing?
Yeah, sure. So, I think it's fair to say banks are low growth, particularly at the moment. But in general, we've seen them as low growth for the last couple of years. So we remain, almost at our max underweight position. There could be an argument made that they've moved into more fair value territory now, but many stocks have been pretty harshly dealt with. The good news for Australian banks is that they are fairly well capitalised, but given recent APRA guidance, we should expect dividends to be cut materially. Now, this is another evolving, really fast evolving space, because as we all know, and as many of your clients know, Australian bank dividends pay for a lot of things for Australians, and so if they were cut to zero, as they have been in many European areas, that would cause a major issue. So I think initially APRA basically said, have a good hard think about how much you want to pay out as a dividend. Reading between the lines yesterday, I think now, probably a base case would be something in the order of maybe a 50% dividend cut at the next dividend payment dates, and then refreshing from there. Typically when you have one of these cycles, let me say this: the big debate we're having, and I spoke to an expert on this the other day who consults across the banking industry, is how do you treat bad debts in this cycle? Because many are getting debt forgiveness, payment holidays on their mortgages, and so should we consider those to be bad and doubtful debts, and it kind of goes to the V-shaped, U-shaped recovery view on this. But post IFRS 9, banks now have to. A criticism of the banks through the GFC was that they were too slow to recognise bad debts in their P&L and on their balance sheets, and that meant it was harder for investors to truly understand the situation with bad debts. So IFRS 9 has now come in, and what that means is you have to take all the provisions that you think need to be taken in the first available reporting period. So if that was the case, you could see a huge bad doubtful debt for the next reporting season because of the debt forgiveness, because of the potential repayment holidays. There's a lot of discussion going on as to what is the right level of provisions to take through the banks at the moment. So, I can't be more definitive than that. But, I think the only thing we can say is that dividends are going to be down a lot. I don't think they're going to be zero now for the majors. But that's something to keep in mind. Our preferred exposure is actually a UK bank, Virgin Money. It's currently trading at a bit above 0.2 times book value, and that kind of pricing suggests severe capital difficulty. We don't believe that's the case. When you consider the mix of the business as well, Virgin is 83% mortgages, which is very high. You compare that to the Australian banks, they're at, on average about 60%, even CBA and Westpac, the most heavily exposed to mortgages, you're talking about sort of low 60s. Virgin also has 3% capital buffer over the minimum, and the regulator has indicated that they are willing to be somewhat flexible with looking through this period. So I actually think they're pretty well positioned out of this. But overall, we are underweight the banking sector because it is low growth, and we just don't see much opportunity there.
And someone just on the sides just asked, any view on CBA? Obviously, you preferred Virgin in that space. Any view on CBA, Blakey?
The best capitalised. So they've been holding up the best in terms of their share price performance. We'll probably have the least. It was probably expected around this time of year they'd be doing capital management. So we're very well positioned coming into this. It's a well-run bank. But we sort of struggle with the valuation as it is now, and it's really been recognised by the market. So for us, we prefer NAV at the moment. But yeah, that's what I can say on CBA.
Okay, and probably final questions. We are running out of time. We've had a couple of questions in on Nufarm. What's your view there? Has caused some pain. Any updates on Nufarm?
Yeah, sure. So Nufarm was one of the best contributors to performance last month. And, I just think back a year ago, the company had balance sheet issues. We're in the middle of a drought. And today it's managed to sell their South American business for a very healthy price. So the company is arguably undergeared now. You've seen some really good rainfall in Australia. It looks like we're going to run out of certain crop chemicals. So we've been speaking to farmers lately. These cyclical industries, you do need to be patient sometimes, and what a difference a year makes. So, at the moment we're seeing Nufarm being really focused on trying to ensure there's enough product to meet demand in the market. The US market season is looking quite good. If you remember last year, it was a very wet season. In fact, it flooded, and it was a terrible season. So, I think overall Nufarm is very well positioned. We're still, the thesis really hasn't changed. Market share opportunities have been oversold on the drought, and also, the potential for that omega-3 to continue to come through and be monetized, because that is the sleeper asset in the Nufarm portfolio. So that's sort of where we're at today. I think Nufarm's pretty well positioned through all this.
Okay, Blakey, and look, just a final one. A couple of people have asked, how are you guys going in April in the High Conviction Fund?
Yeah, so we're not going too badly. We do stay fully invested in the market, so we're going up and down with the market. But we're doing around a bit more than 2% over versus the benchmark this month. Obviously we've got a lot to get back over the past 3 months, but certainly heading in the right direction. But again, it's so volatile out there. At the moment we can have our best and worst days that we've seen even on sort of almost since the GFC kind of level, because of the volatility. So when CBA can move 10 to 15% intraday, some of these stocks can move around a lot. So, but anyway, April's been good, but we're always pretty cautious of calling anything in the short term.
Excellent, mate. And we have had a couple of questions on Absolute Return Fund, and we are looking to do a webinar specifically on the Absolute Return Fund in the ensuing weeks. Look, that is all we have time for today. We do aim to keep these updates short and punchy. And for those people who did submit some questions today that we haven't got to, we certainly will be getting to you with a written response on email. For those of you in terms of wanting access to the Firetrail funds, we do have the Firetrail funds available on most of the major platforms, and the funds are very positively rated by the research houses, with Lonsec Zenith and Morningstar covering the funds in that regard. And if the fund is not available on your preferred platform, I would certainly like you to encourage you to get in touch with the Pinnacle distribution team. Hopefully you can see that on your screen. We will be making this webinar available on the Firetrail Investment website, which is www.firetrailinvest.com. and that should be available later today. We'd certainly like to thank everyone for their participation today. If you have any further inquiries, please refer to the Firetrail website or contact that Pinnacle distribution team that you can see there. We'd certainly like to thank you for your time. We look forward to speaking with you on our next webinar via the phone or in the current environment where we're social distancing. We certainly like to let you know that we are certainly here to answer any inquiries or questions that you may have. So goodbye, everyone. Thank you very much and have a great day.